Welcome back to the Dividend Heroes investment channel, where we break down all things dividends in a way that's easy, fun, and profitable. If you've ever looked at dividend stocks and thought, what the heck does all this mean? You're not alone. Today, we're diving into the most important dividend metrics you need to know, and more importantly, how to calculate them. Grab your coffee calculator and maybe a notepad because we're about to turn you into a dividend master. Don't worry, math will be involved, but I promise it'll be the fun kind. Over to you, DH.
Hello, I am the Dividend Hero. I know what you're thinking. Can't I just buy a stock with a high yield and call it a day? Well, sure, but that's like buying a car because it looks cool without checking if the engine works. If you want your dividends to keep coming in and grow over time, you've got to know the key metrics that keep your dividend engine running. Stick around because by the end of this video, you'll know exactly what to look for before making your next dividend investment. Metric number 1, dividend yield. All right, let's kick things off with the most popular metric, the dividend yield. This is basically how much bang you get for your buck. The formula is pretty simple. Annual dividend divided by stock price, then multiply by 100 to get a percentage. So if you buy a stock for $100 and it pays $5 annually in dividends, your yield is 5%. Let's take a real-life example. Say you're eyeing Coca-Cola KO. At the time of filming, KO has an annual dividend of about $1.76 and is trading around $55. So the yield is dividend yield equals 1.76 divided by 55 multiplied by 100, which equals about 3.2%. Not bad, right? But here's the thing. Don't just chase high yields, because that's only one piece of the puzzle. Metric number 2, payout ratio. Next up is the payout ratio. This one is super important because it tells you how sustainable a company's dividend is. The payout ratio shows you what percentage of the company's earnings are being paid out as dividends. The formula is annual dividend per share divided by earnings per share, then multiplied by 100. Let's use Apple, AAPL. Apple's current annual dividend is $0.94 per share, and its earnings per share, EPS, is around $6.05. So the payout ratio equals 0.94 divided by 6.05 multiplied by 100, which equals about 15.5%. That's super low, meaning Apple is only paying out a small portion of its earnings, which makes its dividend very safe. On the flip side, if a company has a payout ratio over 100%, it means they're paying more in dividends than they're earning. And that's a huge red flag. Metric number 3, dividend growth rate and CAGR. All right, the dividend growth rate is where the magic happens. This tells you how fast a company has been growing its dividends. We can do so specifically using CAGR. Compound annual growth rate. You want companies that consistently grow their payouts because that means your passive income will keep increasing over time. CAGR gives you a clearer picture than simple growth because it accounts for the compounding effect over time. You can calculate the growth rate using the following formula. Growth rate equals new dividend minus old dividend, all divided by old dividend multiplied by 100. The formula for CAGR is new dividend divided by old dividend raised to the power of 1 divided by the number of years, then subtract 1. This formula smooths out any year-to-year volatility and shows you the consistent growth rate. Let's look at Johnson & Johnson, J&J, which has been growing its dividend for decades. In 2010, J&J's annual dividend was $2.11. Today, it's around $4.76. So the growth rate over that period is growth rate equals 4.76 minus 2.11 divided by 2.11 multiplied by 100, which equals 125.6% over 14 years. Using CAGR to calculate the average growth rate over 14 years, we get CAGR equals 4.76 divided by 2.11 raised to the power of 1 divided by 14 minus 1, which equals about 6.1% per year. That's some solid growth. This is why looking at the 5-year or 10-year growth rate is key. It shows you whether a company is committed to rewarding shareholders over time. Metric number 4, yield on cost. Now, this is one of my favorite metrics, yield on cost. It's basically the dividend yield you're earning based on the price you paid for the stock, not the current stock price. This is awesome for long-term investors because as a company increases its dividend over time, your yield on cost grows too. You can calculate this by yield on cost equals current dividend divided by initial purchase price multiplied by 100. Let's say you bought Realty Income 5 years ago when it was trading at $50 and the annual dividend was $2.40. Today, the stock is around $60 and the dividend has grown to $2.96. So, your yield on cost would be yield on cost equals 2.96 divided by 50 multiplied by 100, which equals 5.92%. That's higher than the current dividend yield on the stock because you locked in a lower purchase price. As dividends grow, your yield on cost keeps increasing. This is how you build wealth over time. Metric number 5, total return. Let's not forget about the total return. This is the combo of your dividend yield and any stock price appreciation. Remember, we don't just want high dividends. We also want our stock price to go up over time. The formula is dividend yield plus stock price appreciation. Take Realty Income, again, which is known for its monthly dividends. It has a yield of about 5%, and over the last few years, the stock price has appreciated by 3% annually. So total return equals 5% plus 3%, which equals 8% per year. Not too shabby for an investment that pays you every month, right? Metric number 6, free cash flow. Now, let's get a little deeper. Free cash flow is a great metric to check if a company can actually afford to pay its dividends. Free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures. Basically, the money it uses to keep its business running. You want to see that the company's free cash flow is greater than the dividends they're paying out. You can calculate free cash flow by taking the operating cash flow and subtracting the capital expenditures. Let's take Microsoft, MSFT. In 2023, Microsoft had a free cash flow of about $61 billion. They paid out about $19 billion in dividends. That means Microsoft is in great shape, with tons of cash left over after paying dividends. Safe dividend. You bet. Bonus metric, dividend safety score. Some tools, like Simply Safe Dividends, give you a dividend safety score. This score uses calculations like payout ratio, debt levels, and earnings consistency to give you a real-time idea of how safe a company's dividend is. While it's not a formula you calculate yourself, it's an amazing tool to have. Companies like Procter & Gamble, PG, or Johnson & Johnson, J&J, consistently rank high on the safety scale, usually above 80 on a scale of 1 to 100. This means their dividends are considered very safe, even in a recession. Compare that to a riskier stock like Altria, MO, which might have a higher yield but a lower safety score. These are some metrics to look at when evaluating a company for dividend health. Things like market trends, customer loyalty or sentiment, and the overall economy, however difficult to calculate, should also be taken into account. Now back to the studio.
All right, now that we've broken down the most important dividend metrics, you're ready to start making smarter investments. Let's recap quickly. Dividend yield gives you the percentage of return based on dividends. Payout ratio shows how much of a company's earnings are going into dividends. Dividend growth rate and CAGR tells you how fast a company is increasing its dividends and its compounded growth. Yield on cost shows how your dividend yield grows over time based on your initial purchase price. Total return combines dividend yield with stock price appreciation. Free cash flow lets you see if the company can actually afford to pay its dividends. Tools like the dividend safety score can inform you about the company's debt level, earnings consistency, and dividend history. Armed with these metrics, you can start building a dividend portfolio that doesn't just pay you today, but keeps growing over time. So what are you waiting for? Get out there, do your research, and make your money work for you. And if you're new to investing, Don't worry, take it slow, start small, and let those dividends compound. If you found this helpful, smash that like button and hit subscribe so you never miss out on dividend tips, portfolio updates, and stock picks. Let me know in the comments what dividend stock you're currently watching, and if you have any questions, drop them below. Our hero loves chatting with you guys about this stuff. Until next time, keep building those dividends and I'll see you in the next video. Just a quick reminder, this video is for educational purposes only. I'm not a financial advisor, and investing involves risks, so make sure to do your own research or consult with a licensed professional before making any decisions. The stock market can go up, but it can also go down, so invest wisely.